Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about what I believe to be the top 7 provisions that came out as a result of the Secure Act 2.0. So, for those of you that may not be familiar with the Secure Act 2.0, that's some new legislation that was passed in December of 2022, and it's having an impact on a variety of different issues as it relates to your retirement planning. So, in this video, I'm just going to kind of go rapid fire through again what I think are those top 7 provisions from the Secure Act 2.0. So, number one on the list, and I think quite honestly, the area that's probably getting more discussion and more conversation than almost anything else are the changes that are coming to the required minimum distribution rules. So, something you've probably heard me talk on the channel before about, and maybe you already know, when you get to a certain age, the IRS is going to start mandating that you take minimum distributions out of your traditional retirement accounts each year. And that's what's called the required minimum distribution rules. So, used to be 70 and a half was that magic age that you got to when those RMDs needed to begin. And then with the Secure Act 1.0 a couple years ago, they changed that from 70 and a half to age 72. And now here with this latest legislation, Secure Act 2.0, that's now being bumped up to age 73 for those of you that turn 73 in 2023. And then it's going to be pushed out to age 75 for anybody born in 1960 or later. And that's going to begin basically about 10 years from now in 2033. That'll be age 75 for required minimum distributions. So again, this is something that goes into an overall financial plan, but having a little bit of a delay, is that something that gives you some advantages to maybe pushing some of those distributions out, keeping you in a lower tax bracket. Maybe it gives more opportunity for doing Roth conversion, something we've talked about on the channel here. But those are the new rules. Basically, 2023, it's going to be age 73 for RMDs, and then beginning in 2033, it'll be age 75 for those required minimum distributions. Number two is going to be expanded Roth contributions. So under the Secure Act 2.0, Roth contributions are now allowed for simple and SEP IRA contributions, something that previously wasn't eligible for a Roth. Also, too, if you have employer match, that employer match is now also eligible to go into a Roth account within your employer-sponsored retirement account. So it used to be, for example, that if you were contributing your own money to a Roth 401k, for example, the employer match still went into a traditional portion of that retirement account, meaning that you pay taxes on that later. So now under the Secure Act 2.0, that's going to also be eligible to go into a Roth. And of course, what that means is that you'll have to pay taxes on that money as it goes in, but then enjoy the tax-free benefits of those employer contributions building up, hopefully over time. Number three is a big one. This is going to have a pretty big impact for some individuals on their ability to do a catch-up contribution into their employer-sponsored retirement accounts. Now, this is something that's not going into effect immediately, but beginning in 2025 for certain individuals, specifically those individuals that are either 60, 61, 62, or 63. So for those 4 years, you're going to be allowed an extra catch-up contribution into your employer-sponsored retirement account. So for example, currently in 2023, the catch-up contribution for individuals that are 50 years old or older is an extra $7,500 that you can put into your employer-sponsored retirement account. So beginning in 2025, that number is going to be that $7,500 or whatever that happens to be for 2025, plus the greater of either an additional $10,000 contribution or 50% more than what the regular catch-up contribution happens to be for that particular year. So again, I don't know why they chose to just have it for those 4 years, but for individuals that are getting closer to retirement, I guess that's maybe some of the thought process there. You're going to be able to put some extra money into those retirement accounts. But again, that doesn't begin until 2025. Number four is going to be another change that's going to impact your catch-up contributions. So beginning in 2024, if you have income greater than $145,000 for the year, then all of your catch-up contributions are going to need to go into a Roth account, effectively meaning that you'll pay taxes on that money as the money goes in. Now, as long as you're taking qualified distributions in retirement, you'll still be able to get the advantage of the tax-free growth of that money. But I guess this is one way the IRS is trying to get a little bit more tax revenue up front. Number five is a big one and something that I'm very excited about because I think there's some really neat planning opportunities and some strategies that some individuals may have available to them if they've got some money left over in a 529 plan. So as you probably know, a 529 plan is an education savings account where money goes into the account, basically grows tax deferred. And as long as that money is used for qualified higher education expenses, that money comes out completely tax free. So any gains or growth that you may have had in the account, you don't pay any taxes on that. It's kind of like a Roth IRA account for education purposes. Well, with the Secure Act 2.0, they now have a provision beginning in 2024 that if you have money left over in a 529 plan, as long as that account has been open for at least 15 years, the beneficiary of that 529 plan can then use some of that money, up to $35,000 over their lifetime, to help fund a Roth IRA account in the name of the beneficiary. So that's one stipulation. The beneficiary of the 529 has to match who the owner of that Roth IRA account is. But this is really kind of neat. So for example, for 2023, the contribution limit for a Roth IRA account is up to $6,500 if you're under age 50. It's $7,500 if you're 50 years old or older. So for somebody that may be starting off in life, maybe they didn't use up all of the 529 plan for their college expenses and there's some money left over into this, this is a great way they can then transition some of that money to help fund some of their retirement. Now, you are going to be limited to the Roth contribution limits. Again, $6,500 for under 50 and $7,500 for 50 years old or older. And you're also going to have some income restrictions there as well, meaning that you have to have at least enough earned income to be able to fund that contribution. So if somebody only makes $3,000 for the year because they're just doing some internships or something, they're only going to be able to fund that Roth IRA account for $3,000. They're not going to be able to utilize the full $6,500. One other thing as it relates to income restrictions, normally Roth contributions do have some very heavy income restrictions. If you're over certain amounts, you can't contribute to a Roth IRA account directly. So for this purpose, for moving money from 529 to Roth, that's not going to apply. So even somebody that's making a lot of money over those Roth contribution limit rules, you're still going to be able to utilize this for those Roth contributions. So kind of a neat thing. We're still trying to figure out some of the details of that. For example, what if you change the beneficiary? How does that work? Or is that something that's even allowed? Do you have to start a new 15-year period for that beneficiary? If you had a lot of money that was left over in a 529 plan, could you use up the $35,000 for one beneficiary and then change the beneficiary to somebody else and then use another $35,000? Those are areas that are very gray right now. We don't really have a good understanding, and they're not things that we would recommend implementing. But you can see where some of this could be going and some of the opportunities for long-term planning, as it relates to helping maybe some younger family members, kids or grandkids, help them get a start with some of their retirement planning. Number 6 is going to be a reduction to the excise tax that would apply to a missed RMD payment. So as we talked about earlier in the video, at certain ages, now age 73 or age 75, depending on what year you were born, you have to start taking minimum distributions from your retirement accounts. And if you miss one of those, it used to be that you pay up to a 50% penalty for a missed required minimum distribution payment. So in other words, if you were supposed to take $10,000 out and you forgot or you missed that, it could be up to a $5,000 penalty. Plus, you still have to go back and take the distribution that you were supposed to take. Well, the good news was that the IRS tended to be fairly lenient on this. There's a form called 5329 that you could file once you realize that you forgot to make one of these required minimum distribution payments, and basically just appeal to the IRS, say, hey, we made a mistake, we missed it, whatever the situation was, and the IRS tended to be very forgiving in that situation. So now what they've done with the Secure Act 2.0 is they've changed that 50% excise tax to a 25% excise tax. But now what they did is they added in an additional 10% tax if you missed that payment. So in other words, if you file a 5329 and you say, hey, we missed the payment, are they going to be as lenient as they've been in the past, or are they going to now use this 10% penalty, which they've just kind of added into the language of the Secure Act 2.0, and maybe they're not going to be quite as lenient. You'll still have to pay that 10% penalty. So anyway, bottom line is don't miss a required minimum distribution payment. Make sure you understand that. It has to be done during the calendar year that you're required, so it has to be done before December 31st, not tax time, April 15th. 15th or whatever that may be for the following year. So make sure you stay up on that. But there is a reduction to that RMD. And then finally, the last item that we're going to talk about here are student loan matching provisions. So for a lot of individuals that may have recently graduated from college and they've got some student loan debt and they're maybe paying that debt, trying to get those balances brought down. Let's say they work for a company that has a 401k plan and they have a 401k match. Well, for some individuals, it may be difficult for them to make those student loan payments and also make the contribution payments to their 401k so they can get the match. So now under the Secure Act 2.0, what they're going to allow you to do is kind of use those student loan payments as a credit towards getting that company match. So that's something that I think will help a lot of individuals out. But if that's somebody that you know or you fall into that situation where you're making those student loan payments, that's a way to still get that match. I think you just have to basically show verification that you've made those payments to your employer. This is all new stuff, so they're trying to figure out still what the process is going to be for that. But know that you could probably still get the match under the Secure Act 2.0 rule. So anyway, there you have it. Those are 7 of what I think the key provisions are for the Secure Act 2.0. Again, there's a lot more and gets into a lot of different categories, but these are what I thought were the biggest ones. So anyway, hope you enjoyed the video. If you do, make sure you hit that like and subscribe button. Also, too, I didn't mention it already in the video, but we've got some links down below. So if you want to learn more about what we do for our clients with our comprehensive financial planning, you can go to wealthvisionplan.com or you can click on the link below. We also have our retirement planning course, very comprehensive, very detailed. That's called the Retirement Time Machine, and we've got some links down there below for that as well. So with that, I look forward to seeing you back in one of our next videos. Thanks.